The stock market's wild swings are not just about investors winning and losing. They quietly change how fast your savings grow and how long your money lasts. If you're ignoring volatility because you just keep cash, you're missing the lever that's been moving your future behind your back. You felt it without naming it. Your high-yield savings rate jumped, then dipped. Your 401k looked 12% higher, then 3 weeks later, it gave back half. Your favorite bakery raised prices twice this year. Your landlord wants another $200 a month, and your bank keeps pitching a shiny new certificate of deposit that expires just when the rules change again. You're not a day trader, so why does every market headline still end up in your wallet? Here's the hidden part. Volatility doesn't live on Wall Street. It spills into your rent, your interest rate, your job security, even how much your emergency fund can actually protect. And once you see the mechanism, you stop reacting and start steering. Think about one simple moment. The market falls hard on a Tuesday. Headlines say panic. What happens to a saver on Wednesday? Investors run to safety, so money floods into short-term treasuries. Prices of those jump, which means their yields tick down, sometimes in hours. Meanwhile, banks that rely on your deposits watch that shift and quietly adjust their offers. Online banks that already pay 4 to 5% move faster. Big banks barely flinch. Money market funds that hold government bills reprice daily. Your savings account? It lags. That lag is your opportunity window or your silent penalty. But here's the twist. Sometimes the market falls because inflation scares everyone, and then yields jump the other way, fast, because people dump bonds to raise cash. Same storm, opposite wind. If you know which wind you're in, you choose the right sail. Let me make it concrete. Maya's saving for a down payment she wants in 18 months. In calm markets, she parks it in a government money market fund earning around 5%. Then stocks drop 10% in a week. Fear spikes, and traders suddenly expect the Fed to cut rates sooner. Treasury yields slip from 5 to 4.6 in a day. Money market yields soon follow. Banks will cut their posted rates slowly. Maya has two choices. Lock a one-year treasury or CD today to capture the still high yield, or ride the variable rate that likely shrinks next month. If she locks, that down payment grows predictably. If she drifts, she don't control the outcome, the headline does. Same savings, different result, because she understood how volatility moved cash yields. But there's a catch. People hear volatility and think, hide everything in cash. Safer, right? Not if your timeline is long. Cash looks steady, but inflation nibbles it like termites. You don't see the damage until a beam gives way. When stocks whip around, the equity risk premium, the extra payoff for owning businesses, often rises. Translation: the future expected return for long-term investors usually gets better after a scare. So for your retirement money, a plunge can improve your forward odds, not worsen them, if you keep buying. That's the counterintuitive truth most savers miss. Volatility punishes impatience and rewards discipline. Why do banks play this game with your rate? Because your deposit is their raw material. In uncertain markets, funding becomes precious. Some banks pay up to attract sticky savers, others lean on your inertia. That 5% headline rate might be a teaser with hoops, while your old account sits at 0.4. Most people never move. The bank counts on that. The fix is simple and powerful. Become a rate mercenary. If your savings has a job in the next 2 years, make it earn its wage. Compare your current APY to the latest 3-month Treasury yield. If you're more than 0.5% below, you're donating money to your bank's marketing budget. Wait, it gets stranger. Volatility doesn't just touch the interest you earn, it brushes your paycheck. When markets wobble, companies freeze hiring faster. If your industry leans on financing, Tight markets make managers cautious. Raises get smaller. Bonuses shrink. That matters for savers because your savings rate, what you set aside each month, is the strongest lever you control. In bumpy times, your income buffer needs a seatbelt. That's your emergency fund. And volatility changes how you build it. In calm times, 3 months of expenses might work. In shaky labor markets, 6 months is the new minimum. Not in a bank with a rock-bottom yield, but in a government money market or laddered treasuries, so your safety also earns. Here's what nobody tells you. The biggest risk for savers isn't a red stock chart. It's a time horizon mismatch. Money you need in 6 months has no business flirting with the stock market. Money you need in 6 years has no business trapped in cash. Volatility forces you to choose which rule you'll break, certainty or growth. Don't break either. Use buckets. Bucket 1 is your emergency fund, 3 to 6 months of must-pay bills in a treasury-only money market or a rolling ladder of 4-week and 13-week bills. Bucket 2 is near-term goals under 3 years, short, laddered treasuries, or CDs that mature when you need them. Bucket 3 is everything beyond 5 years, diversified stock funds, and some high-quality bonds for ballast, bought automatically every paycheck so emotion can't meddle. Remember that bakery with higher prices? Their flour costs surged, their delivery truck payment got pricier as rates jumped, and their line of credit tightened when markets turned choppy. They raised prices to survive. That's how volatility shows up at the register. Your rent? If your landlord's mortgage reset higher, your rent follows. Your credit card APR? It floats with short-term rates that move when markets jolt. The chain is simple. Turbulence shifts rate expectations. Expectations move borrowing costs. Costs ripple into prices you see. The reason your paycheck buys less isn't abstract policy. It's 1,000 small rate changes compounding into real life. But here's the part that changed everything for me. Volatility creates temporary mispricings for boring, safe choices. In panics, some banks overpay for deposits. You can lock surprisingly high yields with FDIC insurance. In euphoric rallies, banks underpay because they can money market yields lag if the path of cuts is clear. If you set a monthly 5-minute habit, check the top nationally available CD and Treasury yields, you'll catch these windows without living online. It's like grocery shopping on sale day for the same milk and eggs. Nothing risky, just smarter timing. A quick detour that matters. Safety isn't only about price stability. It's about legal protection. Bank savings and CDs carry FDIC or NCUA insurance up to $250,000 per depositor, per bank, per ownership category. Government money market funds invest in treasuries and repurchase agreements backed by treasuries. But they aren't bank accounts. They aim to maintain $1 per share and have done so through countless storms. Brokerage cash sweeps often earn far less than you think. And those shiny apps promising sky-high yields? Ask what backs them and whether you're insured. In the last bank scare, people with uninsured cash had a very bad weekend. Savers who respected the limits slept. You might ask, what if rates fall quickly while I am sitting in variable cash? That's why ladders exist. Imagine 4 rungs, 3-month, 6-month, 9-month, and 1-year treasuries. Every quarter, one matures. If yields rise, you reinvest higher. If yields fall, you still have older, richer coupons paying you. The ladder turns guesswork into a system. And for long-term investing, the twin to the ladder is automatic contributions, weekly or bi-weekly, that buy whether the market is glowing or grim. When volatility pulls prices down, your same dollars buy more shares. When it pushes prices up, your shares grow. You don't predict, you progress. Let's address 2 objections that usually show up here. First, I don't have enough to bother. If you can set aside $40 a week, that's over $2,000 a year. In a 5% account, It earns interest while you sleep. As rates change, that interest compounds faster when you chase the top safe yield. Second, what if the market keeps crashing? If your short-term buckets are intact, your long-term money can wait. That's the safeguard. You're not forced to sell at bad prices to pay next month's rent. Sequence risk. The danger of a downturn at the start of retirement is scary only when cash and near-term bonds are missing. Build those, and volatility turns from threat to background noise. And this is where things get interesting. The same volatility that scares savers also creates one more lever: rebalancing. When stocks sprint ahead, sell a slice and refill bonds or cash. When stocks sink, move a slice of bonds into stocks. The discipline is mechanical. Pick a band, say 5 percentage points, and act when your mix drifts beyond it. Over decades, that habit quietly buys low and sells high without drama. It also means your safer buckets don't get raided for the wrong purpose because your rules decide before your feelings do. So what should you watch practically without becoming a screen zombie? 3 dials tell you almost everything. 1. Short-term treasury yields because they anchor what safe cash should earn. 2. Inflation trend because it decides whether cash keeps its power or loses it. 3. Your job stability because your personal recession risk matters more than any headline. If your industry is wobbling, you extend the runway on your emergency bucket. If inflation cools and rates start sliding, you consider locking some CDs before the floor gives way. If markets swing, but your timeline is long, you keep buying and let volatility raise your future expected return without asking permission. Tomorrow, do this. Check your current savings rate and compare it to the latest 3-month Treasury yield. If you're behind, move. Split your cash by timeline: emergency, near-term, long-term. Build a simple Treasury or CD ladder for money you'll need within 3 years. Automate retirement contributions weekly or bi-weekly. Set a calendar reminder every month to glance at those 3 dials. And write one sentence you'll follow in storms. If stocks fall 20% while my job is safe, I keep buying on schedule. If my job wobbles, I pause extra investing and refill bucket 1. Clarity beats courage when the screen turns red. Most people think volatility is a flashing siren for traders. It is actually a translator. It tells you when safety is paying unusually well, when to lock what you need, and when to let the rest ride. It explains why your bakery charges more, why your landlord renegotiates, why your bank becomes generous on Mondays and stingy by Friday. Once you hear that language, you're not surprised anymore. You're early. We started with a simple claim: those wild swings move your future. Now you've got the map. You know that cash isn't protection unless it's in the right place, at the right rate, with the right horizon. You know that long-term money shouldn't flinch because fear makes expected returns fatter, not thinner. You know that banks bank on your inattention, and that 5 minutes a month can hand you back thousands over years. You know that volatility doesn't take your power. It offers it, if you take it on your terms. The wind will keep changing. It always does. Savers who drift let the market shove their goals around. Savers who set their sails with buckets, ladders, automation, and simple rules move anyway. Calm or storm. That's the hidden truth. Recent stock market volatility isn't a threat to your savings. It's a signal. If you can read it, you don't just keep your money safe, you make it work.